After being one of the worst performing stocks in 2022, Adobe has actually been one of the best performing stocks of 2023, especially over the past month or two. It's up over 40%. Pretty amazing. Those are the kind of opportunities I like whenever, the stock is going down for nothing pretty much related to the fundamentals. Some things that makes the market, change its mind and just get pessimistic. In case of Adobe, it was some things with the business model, but it was also the acquisition of Figma. This is typically what happens. And then, any kind of bad news that come out, maybe an earnings beat, maybe an analyst upgrading some kind of stock, like what happened with Meta, what happened with CVS in 2017, 2018. This is what happens, and then the stock reverses, and then you have the same thing to the opposite direction. And this is what's actually happening with Adobe. There's a massive change in sentiment, and I made a video on Adobe around $285 per share, and many of you found my YouTube channel and even joined my own investment group because you found my Adobe video, and I said the stock is a buy, and I ended up buying it in my portfolio. But as I have a mistake of selling things a little bit too early, I actually got out of Adobe before we have seen the huge rally that we have seen recently, and I'm working on kind of keeping stocks that are growing and not treat all stocks, like kind of cigar butts, or treat them all the same. So in this video, I'm gonna try to analyze Adobe again, analyze the fundamentals, and see if this is maybe too late to get into Adobe, if it's the time to sell Adobe, the time to buy Adobe, and what I believe Adobe is worth in general after the massive rally. And if we look at the income statement, Adobe is one of my favorite business models, mainly because of the subscription-based revenue. Most of their, kind of revenues and net income is subscription-based, is recurring, I believe 97 or 98%. This is amazing, and they have been experiencing, some subscription growth and, total revenue growing in general. We look at the cost of revenue, it's pretty much nothing. They make $4.5 billion in revenues. It costs them $436 million. Very high margin stuff. I mean, just an amazing business model, one of my favorites. You look at the gross profit, it's also up. Net income is up, operating income's up. So things are actually improving for Adobe, and they did, post a pretty big beat in terms of their guidance. They actually upped their guidance for Adobe, and now their EPS per share estimate is between $11.15 to $11.25 EPS for GAAP. And if you look at the non-GAAP, and this is something I'm gonna talk about, the non-GAAP is between $15.65 to $15.75. So that's a big difference from $11.15 to $15.65 between GAAP and non-GAAP. And one of the reasons why you have this happening with Adobe and a lot of the other tech stocks, and if you could see it even, in the kind of in the history of the company, same thing in 2022, 2023, 2024, huge difference. And this really messes up the PE ratio depending what kind of PE ratio you're looking at. But one of the reasons why that happens with Adobe and with many other tech companies is because of the stock-based compensation. It's massive. It just keeps growing. Look at Adobe. It's huge. And this really hurts shareholder in terms of stock dilution if the company is not buying back stock to kind of offset it, but it makes the non-GAAP net income or EPS looks much better than it actually is, which is why I kind of prefer using GAAP numbers with those companies, but Wall Street tries to value them on non-GAAP numbers, so we're gonna use whatever Wall Street uses and whatever most people use, and we're gonna use more of a non-GAAP numbers. And if you look at the PE ratio, and this is the normalized earnings, which is non-GAAP, it's now sitting at 29 times earnings. Now 29 times earnings, as you can see, Adobe is kind of getting back to the mean, and the mean was around 29 times earnings. Now it's around 29.5. So after dipping below the mean, now Adobe is getting back to the mean, and the company traded as high as 62 times earnings and as low as 9 times earnings, and this was, I believe, in the 2008 to 2009 financial crisis. But this is pretty much the EPS on non-GAAP. But if you use the GAAP EPS, Adobe is trading around 40 to 45 times earnings, which is a huge difference. By using those numbers and even the other numbers, Adobe is pretty much getting back to the mean. So it's getting back to its, fair historical value if it keeps growing at the same pace it's been growing before. And if we take a quick look at the, balance sheet for Adobe, there's not much to look at because it's an amazing balance sheet. They have, 5.4 billion of cash, short-term investments. Total is pretty close to, around $6.6 billion in terms of cash and cash. They pretty much have, no debt. They have some deferred revenues, 5.2 billion. They have some debt, 3.6 billion, but this is nothing. The cash position more than covers it. So it has an amazing balance sheet. I'm not going to waste time on the balance sheet. I talked about it in other videos. I'm going to try to get straight into my valuation model to try to determine if Adobe is a good buying opportunity at such prices, or is it too expensive? Is it still cheap? Is it too late to get into Adobe? This is what I'm going to try to figure out in today's video. Now, if we look at Adobe over here and we look at the revenue growth, I put in 10% revenue growth from 2023 to 2027, which is kind of in line with the analyst estimates and in line with the guidance from the company. So I believe 10% is actually fair for Adobe. I use their net income margins, the non-GAAP net income margins of 36.5%. So I kept it at 36.5%. PE ratio, I used 25 times earnings. And if you actually look at the PE ratio, now it's sitting at 29 times. And I'm actually betting that it's going to trade at 25. So I'm betting on a multiple contraction. The main reason I'm betting on a multiple contraction for Adobe of around 25 from 29, the main reason for that is that I believe Adobe cannot keep growing 10% forever. Eventually, the company is going to get to a more and more, mature stage. Maybe they can do some things with AI and stuff and grow a little bit more. But I would not bet on Adobe growing at 10% after 2027. I would bet on 6, 7, 8%, which could potentially lead to a multiple contraction. So I believe 25 times earnings is a much safer bet than 29 times. But I'm going to try both numbers. Now, using 25 times earnings, and using a 1.5% buyback yield, meaning if Adobe continues buying back 1.5% of the market cap, and this is what it's been doing, around 0.5%, 1.25, 1.5, around 2% in 2022. So I used 1% in terms of buyback. In total, the upside is 21%, and it's only a 4% CAGR for the next 5 years, which is very, very low. Now, even if you use 29 times earnings, which is the mean multiple, and I believe it's not conservative, but if you use 29 times, you get 40% on the upside, or 6.9% compounded every single year for the next 5 years. If I put it back at 25 times, for me to double my money over the next 5 years with Adobe and get a better CAGR on my returns for me holding the position, I have to buy Adobe somewhere around $300 per share. And if you look at $300 per share, it's pretty much where Adobe was trading at, around September or October of 2022. And this is what I said, Adobe is actually a good buying opportunity. Now, after this massive rally, I'm not sure if Adobe is getting back to 300, but if it ever gets back to 300 or below, I think Adobe is an amazing, stock, and I hope you hold it for the long term. You don't sell it, like I did, but I would not be buying Adobe here, even though it could go higher. Maybe the multiple goes to 35 or 40, but this is not something I want to bet on. I don't think Adobe is a buy at such prices. I think there are better opportunities in the market, but if it ever gets to 300 or below or close to 300, I think Adobe then is a good and safe buying, opportunity. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.